We're above 5,200. That's the first time we've ever seen that. Question, of course, can it keep going? Trivariate Research CEO Adam Parker joins us here at Post 9. All right, can it keep going?
Good morning.
Good morning.
Of course. Of course it can.
Thank you, Adam. That was a great segment.
I mean, it's just, to me, I listen to that segment and I think, great that all the bulge bracket firms can tell me what I can read that the Fed said. It would be a lot better if they could predict what they were going to do, with any accuracy 6 months in advance, and they demonstrably can't do that. I can't either, so I don't waste any of my time.
Neither can the Fed.
Yeah, so it's not a good use of time. To me, the bull case is three-pronged. One, the average company is showing gross margin expansion. You want to short stocks when gross margins are going up? Have at it. I don't think that's a good idea. Two, I think it's pretty reasonable that earnings will grow. Usually stocks go up. When their earnings grow, it's correlated to the gross margins. And three, whether they do 2, 3, 1, 0, 4, the Fed's directionally going to be accommodative. And as you pointed out, Sarah, except for Japan, mostly a synchronized kind of process across the globe. So I'll just keep it simple. Fed's you want to fight the Fed and you want to fight stocks where gross margins are going up? God bless you. Go ahead. I don't want to do that. I want to own stocks where the margins are going up and they're being accommodative. And it's that simple. I think the risks, David, are U.S. consumer slows more than people think. The liquidity issue on the tightening part of the balance sheet becomes more of an issue than the front-end accommodation. Or China just continues to be awful, and the companies that we look at in the U.S. continuously tell us that demand's degrading. Those are the three bear cases I see, but I think the positives outweigh the negatives still at this point.
And in part led by margins. But, Adam, it's a benefit for us that you are a frequent guest here. But that said, I remember many of the things that you said, and I do recall you seeing a trough. Sort of, you did not think that earnings were going to grow significantly, if I recall, 24 over 23. Do you see it differently now?
So what you're talking about was in January of 23, when we forecasted earnings for 23 and 24, where we were sort of way above consensus on 23, but didn't see a lot of recovery in 24. We raised our numbers 5% for 2024 since the beginning of 23, mostly because the top 20 U.S. equities just produced way higher earnings growth than I thought, and that disproportionately weighed. So I think it's a hard game to forecast, but I think we did okay there. We're still below consensus. The bottom-up numbers are usually too optimistic. I think what people get confused about is they think, the estimates are too high, and there's going to be downward revisions, and that's bad for stocks. That's not true. Okay, all the time, the estimates are too high in January, and they get downward revised, and the market can still go up. All that matters is you think in the middle of this year, earnings are higher next year. That's what matters. So, there can be some downward revisions this year. I think there will be. But as long as earnings grow, and I think they're going to keep growing in absolute terms, usually equities work.
We were in the makeup chair together, not in the same chair, but in the same room.
Yeah.
And you were telling me that
Scandalous.
Companies were being more wishy-washy on conference calls.
Yeah, we do. There's this famous Notre Dame professor, Tim Lochran, and his colleague McDonald. Lochran and McDonald have like the Merriam-Webster of language processing. They have a dictionary. And we took their, what they call weasel words, which are sort of non-committal, uncertain words. I should have, I could have, I don't know, uncertain. And we actually analyzed every earnings call transcript of every company back for 10 years. And we looked for management teams that get increasingly uncertain in their language. And we found it is a negative harbinger if they get more uncertain, and a positive harbinger if they get a little more certain in their answers. There's a lot of quantitative being work done on this topic as people parse every word of every transcript. And so, traditional quant, meaning you buy stocks that are cheap, short, that really hasn't worked for a decade, right, in terms of longer horizon. So we're all trying to get more creative about ways to gauge management confidence, manage uncertainty.
But those levels are up, the weaselly words.
They spiked huge during COVID, which makes sense. They came down. On average, management teams and human beings use weaselly words all the time. But to the extent that they're getting less certain, it makes sense to me that would be a negative, a predictor of their subsequent return. And it works particularly for value stocks and low-quality stocks where you're really not buying a quality business today. You're hoping it improves in its quality over the next 6-9 months. And if the management team's a little bit more confident, it makes sense that'd be a value stock worth, taking a shot on, whereas they're getting less confident, less certain. That certainly wouldn't be good if it came to their.
What are you using here? AI to run this thing? Is it like ChatGPT?
We have our own proprietary language processing tool.